All right, welcome everyone. Today we're diving into a topic that, I'll be honest, can sound a little dry on the surface, depreciation. But let me tell you, this concept is one of the absolute cornerstones of financial accounting. If you can get a real intuitive grasp of this, you'll be able to understand the true health of a company. But if you get it wrong, well, that's how some really disastrous business decisions get made. For anyone in this room who is serious about a career in business, this isn't just an optional topic, it's absolutely essential. So let's get right into it. So to kick things off, let's start with a really practical, everyday scenario. Imagine you started a small business and you make a major purchase, a $50,000 delivery van. Now think about it. This isn't like buying paper clips or paying the electricity bill. This is a significant asset, something you expect to use to generate revenue for years to come. So here's the fundamental question. How do you properly and fairly account for that massive $50,000 cost on your books? This is the core puzzle we're going to piece together today. So here's our game plan. First, we're going to really dig into the problem itself, what I call the plant asset puzzle. Then, we'll introduce the solution to that puzzle, the concept of depreciation. After that, we get to the most critical part, the why, the matching principle. And I mean it, if you understand this one principle, you'll understand half of financial accounting. Then we'll touch on the how by looking at a few different calculation methods. And finally, we'll tie it all together and see why this matters for the big picture decisions you'll be making out there in the business world. Okay, let's jump into section 1. The plant asset puzzle. First off, what's a plant asset? Don't let the name fool you. It doesn't just mean a factory. It's the official accounting term for any major physical asset a company owns that has a long, useful life. Things like buildings, machinery, equipment, and of course, our new delivery van. And the puzzle is exactly this. Unlike a monthly salary or a rent payment that's used up right away, these assets provide value for many, many years. So how on earth do we account for that initial cost in a way that actually makes sense over time? Now, here's a very common mistake students make when they first start out. The thinking goes, well, we spent $50,000 this year, so let's just subtract that whole amount from this year's revenue. Simple, right? But I want you to really think about the story that tells. Let's say your business brings in $60,000 in revenue in its first year. If you expense the entire cost of the van, your income statement would show a profit of just $10,000. That is incredibly misleading. The whole point of buying that van was to help you generate revenue for the next 5, 6, maybe even 10 years. To report its entire cost in year 1, well, that completely distorts the picture of your company's actual performance for that period. It violates the entire goal of financial reporting, which is to present a true and fair view. So if we can't just expense the whole thing at once, what's the alternative? And that question brings us right to the solution and to our second section, defining depreciation. This is the brilliant, elegant accounting tool that was created specifically to solve this very problem, the plant asset puzzle. Okay, here's the formal textbook definition. Depreciation is the process of allocating the cost of a plant asset over its useful life. Now, I want you to pay very close attention to the words being used here. The key word is allocating. We are allocating the cost, not expensing it all at once. And we're doing it over its useful life, not just in the year we bought it. And here's another critical point students often get confused about. Depreciation has nothing to do with the asset's market value. It's not about tracking how much you could sell the van for. It is purely, and I mean purely, a process of cost allocation. So let's put that in simpler terms. Think of it like this. You paid all the cash for the van up front, sure, but you are going to consume the value of that van little by little over all the years you use it to make deliveries. Depreciation is simply the accounting mechanism that allows us to record a small piece of the van's original cost as an expense each year, mirroring the way we're actually using it up. The big idea is to systematically spread that one big cost out over time. It's simple, but it's an incredibly powerful idea. And this brings us to what I believe is the single most important concept in this entire discussion, the matching principle. Seriously, if you can truly internalize this idea, you will understand the fundamental logic, the why, behind not just depreciation, but so much of modern accounting. This is not just a rule you memorize for an exam, it's a core philosophy of financial reporting. This quote really says it all. The entire goal is to match expenses to the revenues they help generate within the same accounting period. Think about our van. That van is out there making deliveries, which in turn earns revenue for the company this year, right? So it only makes logical sense that we should recognize a portion of the van's cost as an expense this year to be matched against that revenue. The expense follows the revenue. That's the key. Let's walk through this from a manager's perspective. Okay, I'm the CEO.
I just signed the check for $50,000 for this brand new van. At the end of the year, the board of directors asks me, so how did we do? I can't look at them and say, well, it was a terrible year. Our profits were almost zero because we bought a van. That's absurd. Instead, I can say, we had a fantastic year. This new van helped us generate an extra $20,000 in delivery revenue. And to earn that revenue, we used up about, say, $10,000 of the van's value. So we'll record that $10,000 as a depreciation expense for this year. Do you see how that works? Now the expense is properly matched with the revenue it helped create, and that gives the board and our investors a much, much more accurate picture of our actual profitability.
Okay, so we get it. We know what depreciation is, and we now understand the crucial why behind it, the matching principle. So that brings us to section 4. How do we actually calculate it? The goal is always the same, to allocate that cost over the asset's useful life. But accountants actually have a few different methods in their toolkit to get there. The 3 most common methods you're going to encounter are straight line, units of activity, and declining balance. I want you to think of these as different tools in a toolbox. You wouldn't use a screwdriver to hammer in a nail. In the same way, you wouldn't necessarily use the same depreciation method for our delivery van that you'd use for a piece of heavy machinery that's running 24/7 in a factory. The key is to choose the method that best reflects the pattern in which the asset's value is actually being consumed.
Broadly speaking, these methods fall into 2 main camps. First, you have time-based methods, and the most common is straight line. It's the simplest. If we say the van has a useful life of 5 years, we just expense 1/5 or 20% of its cost each and every year. It's predictable, it's easy. The other camp is usage-based, like the units of activity method. Here, the expense is directly tied to how much you use the asset. So for our van, we might calculate depreciation based on the number of miles we drive. In a really busy year where we drive 30,000 miles, the depreciation expense is high. But in a slow year where we only drive 5,000 miles, the expense is much lower. You see how that perfectly matches the expense to the activity generating the revenue? That's the matching principle in action. And this choice, it isn't just a technical detail. It's a strategic decision that affects how your company's financial story is told year after year.
And that brings us to our final and maybe most important section. Why does any of this really matter? We've gone through the mechanics, we've gone through the theory, but let's bring it all back to the real world of business decision-making. Why should a future marketing director, or an operations manager, or a CEO care so deeply about what might seem like a boring accounting role? It matters because at the end of the day, this is all about telling an accurate financial story. By properly matching your expenses with your revenues, you get a true measure of your company's profitability, and that information informs everything. Is our delivery service actually profitable on its own? Do we have enough real operating cash flow to think about buying a second van next year? Banks will look at these numbers to decide if they'll give you a loan. Investors will analyze them to decide what your company is worth. Getting depreciation wrong doesn't just mess up a number on a spreadsheet, it leads to fundamentally flawed business decisions. So, I'll leave you with a final question to think about as you continue on in your studies. You're going to hear the term non-cash expense used to describe depreciation all the time. And it makes sense, right? The cash, the $50,000, already went out the door when you first bought the van. No actual cash is leaving the company's bank account each year for depreciation. So, if that's the case, why do smart investors and bank lenders scrutinize this non-cash number so incredibly closely? What does it tell them about a company's past investment strategy, the age of its assets, and most importantly, its future need for cash? If you can answer that question, you'll be well on your way to thinking like a true financial analyst.